Bismillahirrahmanirrahim. In the previous class, we were discussing about price to book ratio. Told you about this in detail. Told you about price. Price means market price, and book value means total assets minus total liabilities, which is equal to book value. And then after calculating the book value, this 25 million, 100 million minus 75 million, so we got 25 million. We will divide it by number of shares outstanding. 10 million shares were outstanding, so we got 2.5. That is, book value of share is 2.5. 2.5 is the book value. So then when we calculate price to book value, market value, our price of share in the market, it was $5 and book value was 2.5, so we got $2 book price to book value. Now what does this mean? If a company is trading for less than its book value or has a price to book value less than 1, it normally tells investors one of the two things. It's talking about if this value, in our case, this value is above 1. What is he saying? If a company is trading for less than its book value or has a price to book value less than 1, it normally tells investors one of the two things. So he's talking about if the book value is less than 1, means price in the market, suppose it is 5, and book value is suppose 6. So we will get a value less than 1. It will be less than 1. So if the price to book value is less than 1, it will tell us two things. Either the market believes the asset value is overstated. So now see, this is price, this is book value. Now see, what does it mean basically? Suppose if the price in the market, it is 5, market price of share, it is 5, and book value in the books, it is 6. So it is telling that the value in the balance sheet value, the value in the books, it is 6, and in the stock exchange, it is traded for $5, less than the book value. That the shares of the company are traded for less than their book value. Book value is 6, and in the market they are sold, the shares are sold for $5. So this means that price to book value or price to book ratio, it will be less than 1. It will be less than 1 in points. So 5 divided by 6, 5 divided by 6, so we are getting 0.83, means price to book ratio, it is 0.83, less than 1. So it will convey us some message. Either the market believes the asset value is overstated. The people in the market, the investors in the market, they think that the value that the shares, the market believes the asset value is overstated. That they are showing that in the balance sheet, investors will think that the company overstate this book value. Investors will think that the value of share is overstated in the balance sheet. The first thing, this is the first message. The company is earning a very poor return on its assets. The company's return on assets, it is very poor. Means the company's performance is very poor. So if the value of price to book is less than 1, it will convey us two things. The first thing is this: the market believes, or the investors in the market believes, the asset value is overstated. That the company overstate the value of asset. The second thing, the company is earning a very poor return on its asset, means the company's performance is poor. If the former is true, the first one, the people believes, the investors believes that the value of the asset is overstated. If this thing is true, it shows that there is a chance that asset value will face a downward correction, that the asset value will come down by the market, leaving investors with negative returns. And if the value of asset in the market, it will come down, what will happen? The investors who invested in this company, they will earn negative return. It shows that there is a chance that asset value will face a downward correction by the market, that the asset value will come downward, and if the asset value will come downward, investors will be in losses. The second, if the latter is true, the performance of the company is poor. If the latter is true, there is a chance that new management or new business conditions will come to bring changes and give strong positive returns. But if this is the case, the management is not good, the performance of the company is not good, so there is a chance that new management will come, our new business conditions will come, and they will bring changes. New management and new business conditions will bring changes and give strong positive returns, and investors will earn some positive returns. Two cases in price to book value. One case is price to book value is less than 1. If a company is trading for less than its book value or has a price to book value less than 1, it normally tells investors one of the two things. The first thing, again, listen, either the market believes the asset value is overstated, that the value of asset is overstated. The company is showing the assets high as compared to the actual value, or the company is earning a very poor return on its assets, or the performance of company is not good. Their return on assets, it is poor. So if return on assets is poor, so maybe it will be the mistake of management. But if the first one is true, if the former is true, it shows that there is a chance that asset value will face a downward correction, that there will be a correction in the asset value by the market, leaving investors with negative returns. If investors thinks that this value is overstated, so there will be correction in this. If there is correction in this, then the value of share again, it will further move down. And if they think that the second is true, the management is not good, so maybe there is a chance that new management will come, new business conditions will come, and they will bring changes and give strong positive returns in the upcoming year. If this thing will happen, investors, if they think that this is true, so they will wait for the new management. Price to sales ratio, PSR. In price to earning ratio, there is a problem. What is the problem? Price to earning. If earning is zero, or earning is negative, you can't calculate this thing then. If earning is zero, you can't calculate price to earning ratio. But price to sales ratio, PSR, you can calculate because there will be some sales, at least $1 sale. So it will not be negative. So what is he saying? The ratio of stock price to revenues per share. Revenues, there will be at least $1 revenue. There will be at least $100, $1,000. There will be some revenues of the company. So the ratio of stock price to revenues per share, this is called price to sales ratio. PE ratio can be a problem because a company can have erratic earnings. Maybe they will earn too much, or in some cases no earnings. If there are no earnings, then it will be a problem. In contrast, the PSR ratio can be used to value any public company, including companies with no earnings. Those companies who have earnings, we can calculate price to earning ratio for them. But those companies which have no earnings, we can't calculate price to earning ratio for them. So for that purpose, we are using PSR, price to sales ratio, because sales, it will almost be more than 1, more than 0, you can say. So in contrast, the PSR ratio can be used to value any public company, whether it is strong company, whether it is weak company. So including companies with no earnings. Those companies which have no earnings, we can evaluate these companies. Furthermore, many believes that sales are much more unlikely to be managed by the company as opposed to earnings. Mostly what are companies doing? They're showing their profits high by different methods, by different techniques, using valuation techniques like depreciation, like inventory valuation, like they're using different techniques, showing their debts high. So in this case, companies, they can manipulate the earnings. So many believes that sales are much more unlikely to be managed by the company, but there is no chance of manipulation in sales, as opposed to earning, that is, sales should be much less subject to manipulation than are earnings. In earnings, profit, I'm talking about net profit, earnings. there is much more chance of manipulation, subject to manipulation. You can make changes. You can manipulate the profits by different techniques, just like I told you, using different depreciation methods, using different inventory valuation methods, showing the debts high, or different other techniques. But sales, you can't manipulate sales. If there is sales, you can't manipulate it by different methods. No manipulation. You can't make changes. Same spelling. So you can't make changes in sales. So PSR is equal to share price in the market divided by revenue per share. How you will calculate the revenues per share? Revenue per share is equal to total revenues of the company divided by number of shares. Suppose if total revenues, these are 100 million and number of shares are suppose 20 million. So for per share, we will get revenue per share equal to 5. So then what will you do? What is the share price in the market? PSR, price to sales ratio, is equal to share price in the market divided by revenue per share. Suppose sales price in the market, it is 10 and revenue per share is 5. So PSR, price to sales ratio, it will be equal to 2. So this is how you will calculate PSR, price to sales ratio. Now the last topic of this chapter, it is economic value added. EVA, economic value added, is the profit earned by the firm less the cost of financing the firm's capital. What? Profit earned by the firm, and from that we will deduct the cost of financing the firm capital. What is the formula? Economic value added is equal to net operating profit after taxes, net profit, minus what is the cost of financing. What is total capital multiplied by the cost of capital. What does it mean? Suppose this is our company. This is a bank. We took a loan from a bank. Loan of 10 million. On 10 million, we are paying 8% interest. This is basically financing, debt financing. So we took a loan of 10 million. On that 10 million, we are paying 8% interest. This 8% interest, this is called cost of debt. Cost of debt. Similarly, if you issued shares and you issued shares, you're also paying dividend to the shareholders. So that dividend is basically the cost of equity. So cost of debt, cost of equity, combinedly we call it cost of capital. Cost of capital. This is basically our cost of capital. So economic value added, EVA, it is equal to net profit minus cost of capital. I'm writing shortly. Net profit minus cost of capital. Suppose our net profit, it is suppose 60 million. Out of this 60 million, suppose the cost of debt and cost of equity combinedly, it is 10 million. So we will get 50 million economic value added. Means the value which is added in the equity of the company. The value that is added, now this value, this 50 million which is left, this will be added to the equity of the company. So we call it economic value added. Now, what is he saying? The idea is that value is created when the return on the firm's economic capital employed is greater than the cost of capital. If the firm's economic capital employed, if the return of the company, the profit of the company, is greater than the cost of that capital. Now here, what is our return? 60. What is our cost of capital? 10. So 60 minus 10, 50 will be the value which is added in the company. Now company adds 50 million this year in their equity. This is basically economic value added. Now this means if this is less than this, then it means that company's performance is very poor. See, economic capital employed is greater than the cost of that capital. The value is created. Value will be created when the return on the firm's economic capital employed, the capital which is employed, the return on the capital, that is profit. Profit is greater than the cost of capital. The profit of the company is greater than the cost of capital, cost of debt and cost of equity. Some studies have shown that stock price is more responsive to changes to economic value added than to changes in earning. This is a research topic basically, that majority of studies, majority of research conducted shown that share prices, the prices of shares, it is more responsive to economic value added. Share price will go up if there is economic value added. If economic value added is positive, there will be increase in stock price. If economic value added is negative, there will be decrease in the stock price. Means stock price is more responsive to changes to economic value added. So this is economic value added. Basically, it is net operating profit after taxes minus the cost of capital. How we will calculate the cost of capital? What is your total capital multiplied by the cost of capital? This is the end of this chapter. We have 6 minutes, so we will start the new chapter. The chapter name is Industry Analysis. First of all, what is industry? At first glance, the term industry may seem self-explanatory. You can understand the meaning of industry, that what is industry basically. At its most basic, an industry consists of a group of companies. Industry is basically a group of companies engaged primarily in producing or handling the same products or rendering the same services. Basically, an industry, like you people heard about cement industry. Like you people heard about banking industry. Like you people heard about textile industry. So what is basically industry? Industry is basically a group of companies, making the same product are rendering the same services. So what is cement industry? So cement industry, they are making the same products. Banking industry, they are rendering the same services. What is bank doing? You know about the bank. So they are offering the same services. What is textile? So they are making the same product. Companies in textile industry, so they are making the same product and selling it. So this will be an industry if different companies, they're offering either the same product or rendering the same services. Combinedly, we will call it industry. So a group of companies engaged primarily in producing or handling the same products. They are either producing or they are either handling, or in rendering the same services, or they are rendering the same services. Everyone is familiar with auto industry, vehicle, the drug industry, drugs, medicines, and the electric utility industry, which are making electric utility products. So industry is basically a group of companies which are engaged in the same type of products, or they are rendering the same type of services. Classification of industries. There are different types of classification. The first one is standard industrial classification. First, I will see the length of the video, then we will go ahead. So this video is 29 minutes. So inshallah, in the next class, then we will talk about this thing. So today we discussed about price to book value. What is the meaning of price to book value? Then we discussed about PSR, price to sales ratio. Then after that, we discussed about economic value added, that what is economic value added. We discussed in detail about this thing, and then we discussed about industry, that what is basically an industry. I think for today it is enough. So inshallah in the next class then we will finish, maybe we'll finish in the next two classes, we'll finish this chapter, and then in the next two then we will finish the next one. Okay, have a good time. Assalamu alaikum. I'm in the university, so if you got some problem you can come and you can discuss. Thank you.